This next one isn't going to be just a standard recession. It's not going to be a soft landing. It's not going to be a no landing. This is going to be big because what they've really done is they have broken a 41-year trend cycle, and those do not go out quietly and without a whimper. They may want you to think so because in that way, then you'll fly to the perceived safety. You'll fly to fiat money assets. You will fly to the perceived safety of cash and other things. But the reality is, you want safety? It's this. Because this is the only financial asset that runs no counterparty risk.
With the U.S. economy slowing and inflation falling, there is no urgency for the Federal Reserve to raise its policy interest rate again. Still, it will likely be a long time before rate cuts are appropriate. Atlanta Federal Reserve President Raphael Bostic said on Tuesday, "I'm not in a hurry to raise. I am not in a hurry to reduce either," Bostic said at a Metro Atlanta Chamber event that tried to marry caution over any further rate increases with a commitment to the higher for longer strategy that the Federal Open Market Committee as a whole has adopted for this phase of its inflation fight. According to Lynette Zang, the founder of ITM Trading, the Federal Reserve has exhausted its tools, so we are witnessing a departure from the gold-backed currency system. This shift from gold-backed currency is significant because it has historically provided stability. This change is happening rapidly and could lead to a sudden spike in interest rates. Lynette highlights the pattern that every time interest rates were raised previously, it led to a recession. However, the upcoming economic downturn will not follow the typical recession pattern, but will instead be a major crisis. She attributes this to breaking a 41-year trend cycle, emphasizing that such economic shifts usually come with significant consequences. The global economy is on high alert due to warnings about the colossal $33 trillion debt burdening the United States, which could have enormous repercussions for the rest of the world. The U.S. federal debt has skyrocketed to this unprecedented figure for the first time in history, raising concerns about a potential economic recession and a government shutdown. Lynette points out that during the last financial crisis, the U.S. was servicing a $13 trillion debt despite running trillion-dollar deficits, warning that the global financial system is ill-prepared to handle the risks associated with strains in domestic debt markets. We will now bring you clips from Lynette Zang. But before we do, if you want more videos like this, hit the subscribe button and turn on the notification bell for more updates. Thank you, and enjoy the video.
I want to point out that the Fed is out of tools. I want you to take a look at where we were, right? Transition away from the gold-backed currency, because we're getting near there again. Look at how quickly interest rates could spike. And every time they raise the rates, which you can see here, and you can see here, you can see it here, you can see it here, it caused a recession. This next one isn't going to be just a standard recession. It's not going to be a soft landing. It's not going to be a no landing. This is going to be big because what they've really done is they have broken a 41-year trend cycle. U.S. national debt hits $33 trillion for the first time. In 2009, when I did a study on, if we're only running trillion-dollar deficits, why in the world are we servicing $13 trillion in debt? That wasn't that long ago. That was during the last great financial crisis. We've got another one coming because the solution has always been grow more debt. Grow more debt. What can I say? 33 trillion. Do you think it might? Is there any chance in Hades that that is a payable debt? That would be no. It is not a payable debt. So what you're looking at is the total public debt here. And can you see it ever even attempting to be paid off? And can you also see that every time it hits a gray bar, the speed at which that debt grows faster and faster and faster? I mean, 2020, that's almost straight up, pretty close to straight up. And oh, by the way, the entity that's been buying a lot of that debt, the Federal Reserve, and they have been since 2000, the Federal Reserve is trying to normalize their balance sheet. All of this debt that they accumulated is underwater. All of it. It started out before 2008 at $800 billion. Now it's still at 8 trillion. Did you get that? 800 billion, 8 trillion, and they're trying to liquidate it, to just when a bond or note or bill that they're holding matures, not rolling it over. So we've lost huge buyers in this debt. And what do they think the answer is? Okay, I mean, think about this logically. Is the answer to too much debt even more debt? Because that's always been their answer. You can see it right here. That's always been the answer because that's how money is created in the system. Domestic government debt levels are at alarming levels in many countries. This isn't just a U.S. issue. This is a global issue. Most worryingly, the global financial architecture is not adequately prepared to manage risks associated with strains in the domestic debt markets. Well, if the Fed's been buying our debt, that's the domestic market. And what they're saying here is it's hard to roll that debt over if there aren't buyers.
In a recent CNBC interview, billionaire investor Ray Dalio expressed grave concern about the risky fiscal situation in the United States, going so far as to predict an impending debt crisis. He believes the speed at which the crisis transpires is going to be a matter of supply and demand. Citing Ray Dalio's perspective, Lynette emphasizes that the current financial system is unfavorable to the average person and urges people to prepare for it now. Lynette highlights the risks of holding traditional currencies when confidence erodes and points out that the government's ability to create more money may not safeguard individuals in such a scenario. Gold is often touted as an inflation hedge, helping to protect investors from rising inflation. So when markets get rough, many investors flee to gold to ride out the storm. Over the past 4 quarters, many central banks worldwide have been accumulating gold reserves, and there has been a $747 billion increase in gold reserves in central banks worldwide. Lynette believes central banks are accumulating gold to offset potential losses from holding government debt, especially with interest rates at historic lows, and to maintain their power and financial freedom.
The system is not on your side. And Ray Dalio, who anticipates a revolution, and so do I, he also says the U.S. is going to have a debt crisis. That's coming up. Can I tell you that it's going to be Thursday morning at 3? No, but it could be. The time to get prepared is now. He even says, how fast it transpires, I think, is going to be a function of that supply-demand issue. That's the supply and demand of this stuff. So I'm watching that very, very closely. So I'm watching that very closely. Yeah, me too. Because a failure to reach an agreement could mean a government shutdown and raise the perceived risk of the country's debt. But it's already a risk. This is not risk-free. Your principal may be risk-free because they can go ahead and just create more money and give it back to you. But it's not risk-free because you can't do anything with it once you get it. When all confidence is lost, that's it. Now, I did put this together before Sunday, which is when they went ahead and passed the stopgap bill to not shut down the government. But, you know, it's going to rear its ugly head again and again and again and again and again because we have such a divided and dysfunctional government. And are they really operating in your best half or in special interest best half? Think about that. Because what we know is 7 in 10 central banks surveyed believe that gold reserves will increase in the next 12 months. Yeah. Let's see. If this was such an old relic, why do you think that 71% of central bankers surveyed expect to hold more gold over the next 12 months, right after they have bought more gold in the first half of this year than ever in recorded history? What do you think they know? And what should you know? They know how gold behaves during overnight resets because they take this that has no intrinsic value. It's used in one place, and they reset it against this, which is all intrinsic value because it is used in every single sector of the global economy. And then guess what? This is how gold behaves when they do those overnight revaluations. That still lies ahead, but make no mistake about it, it's coming. And that, I believe, is why they are buying so much gold, to offset the losses that they're already in by holding all that government debt and now at 0% and now ratcheting those interest rates up. But mostly because they want to retain their choices. They want to retain their power and their freedoms.
Looking ahead, the shift from a gold-backed currency system and rapid economic changes could lead to uncertainty, with the added complexity of potential sudden interest rate increases. What are your thoughts on the Federal Reserve's cautious approach to raising interest rates? Share your observations in the comments section below. Also, ensure you like this video, subscribe to the channel, and turn on post notifications for more videos like this. Thanks for watching.